James, I'll just begin with you. How bad is it in Germany for the economy?
Well, I mean, we saw the figures from the second quarter, which saw the German economy actually contracting by minus 0.1%. And this is an economy that's heavily driven by exports, and it's seeing lower sales in China and other parts of the world. So the global slowdown is really starting to bite in Germany, and they are looking, as you said, at potential sort of countermeasures. So they're really suffering.
Steven, why does this matter so much to global bond yields? You know, why is it that the German 10-year pulls everybody's bond yields around so much?
Well, you have to understand, just like Japan, Europe and Germany in particular are heading towards a deflationary spiral. And if they go into this downturn, given the fact that they haven't corrected their banking industry problem after 10 years of growth, just like Japan didn't in the 1990s, they're going to fall into that deflationary spiral as well. And deflation just pulls down bond yields, and that's what's happening. There's a global arbitrage to grab yield, and we're being the other side of that trade. People are grabbing our yields because they're getting negative yields overseas.
So in other words, Japan, Germany, they're kind of first down this timeline, and the worry is that the U.S. might follow suit.
100% correct. There's a fear that we could go down the same wormhole that both Japan and Europe appear to be going down. Japan has gone down. It appears Europe is going down it as well. And really, the problem is a function of the balance sheet. They haven't repaired the banking industry balance sheet after 10 years. We, on the other hand, luckily, we repaired our balance sheet problem. And therefore, even if we go into a negative yield environment, we still have some cushion to keep us from getting into that deflationary track record. But as yields continue to grind lower because the Federal Reserve falls behind the curve in terms of what it needs to do in terms of targeting inflation rather than targeting interest rates, you get into an environment where deflation psychology can begin to build here, as it is in Japan and as it's starting to get established in Europe.
And Cathryn, let's talk about why this deficit spending news was such a big deal. You know, when we talk about Germany, it's almost collateral damage from the slowing global economy and the U.S.-China trade war. Germany, as you've pointed out, is a 50% export economy. That is a huge number. What recourse do they have here?
Well, so the economists here are saying a number of things. They point exactly to that squeeze that you just pointed to, Kelly, between China and the United States, because if you think of the lead industries in Germany, they're machine building, they're automotive, they're the automotive sector. You know, that is really the motor of the economy. But interestingly here, the economists are maybe not entirely optimistic. They're warning, and they're getting a bit screechy, of course, but they're also saying, look, a lot of what we can do now, we can do domestically, and that's what you've already pointed to. There are long overdue structural reforms. Steve pointed that out with respect to the bonds, but there are also structural reforms that could happen right here at home. And I think the news that we got just a few hours ago that the German government is willing to do that indicates that it takes it seriously, and it knows there's plenty of homework it needs to do right here, which is to say infrastructure spending, which is, you know, investment in the digital environment in this country, kind of beginning to really look at diversification and or buffeting that sort of export heavy component of its economy by thinking through other measures. Because right now, frankly, they feel like they're being squeezed from the outside. In German, we call it fremdbestimmt, something that really drives from the outside, that's a diktat from the outside. And the Germans do not like that.
Fremdbestimmt, something. I want to get that right. James, let me ask you, and when we talk about Germany, we're effectively talking about Europe's economy. I mean, it's the biggest part of it. It's often the engine. It's often the leading tell for where everybody else is going. This week, just yesterday, the bigger news was that the European Central Bank had a board member basically saying, we are ready to come out with a big bazooka in September, more bond buying, more interest rate cuts. What's going to be more effective here if Steven's right about what monetary policy has or hasn't achieved? Would these measures that Cathryn's describing do more to help spur growth?
Well, I mean, this is going to be, Mario Draghi's last shot, and I think he's going to throw everything that he has at the problem. And we know that central banks around the world, including the ECB, have limited tools left. So I think he is going to go ahead with more bond buying, and there might be kind of further cuts into negative territory. But I think even the policymakers at the ECB would say it's time for a fiscal policy to sort of step up because the central bankers are running out of ways to handle the situation.